I'm Chris Preston.
I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. Coming to you from the Madison Avenue studios. We haven't said that in a while. In Vermont and Arizona, studios plural. Um, Brad, what's going on in your life? You said something about
So
you had a family board game last night and something about Tron.
yeah, I thought about this to open the show earlier because my family had a blast playing this game called Monikers, where
Hmm.
it's like a guessing game where you can say whatever you want, then like the next round you can only say one word, and the last round you have to like charade it out. Highly recommend to anybody with, a family that does board games. The
Okay.
problem is
Oops.
I think your kids are too young for it. Like
Really?
there's stuff in there, eh, not from a content standpoint, but just from a like your kids aren't going to know who Helen Keller is, right? Like
Yeah.
stuff like that.
Yeah.
But I wanted to ask you about Tron Ares. Apparently that bombed on
Hmm.
opening. Are you a Nine Inch Nails guy?
No. No.
Uh, See that they did the soundtrack for that. That is the only thing that had me putting that like movie on my radar at all. Apparently, I'm not alone. I'm guessing the soundtrack downloads for it are significantly higher than attendees because there are people talking about whether it ends like Jared Leto's leading man career. Like it did that poorly.
I heard a story. There's like this movie podcast I listened to, and one of them went to movie festival or something where Tron Ares was playing. And Tron, what was it? The original Tron came out in like 1982. Jeff Bridges, and
Yeah.
who's I guess makes a cameo in this, but is not the main character. Jared Leto is. Jared Leto's never been in it, and he came out on stage and was like, "All right, Tron Ares," and no, everyone's like, "Who is this guy?" And it was just very tepid applause, and I guess that's symbolic of the movie response to the movie itself. My son had been asking about going to a movie. And I was like, "Oh, you go to Tron Ares? That's one of the few that may be in the realm of appropriate for his age." And he's like, "No, it's not
Yeah.
it." Yeah,
I feel like everybody that was like, oh, Nine Inch Nails is doing that. Like they just went on Apple Music and just listened to it and then skipped the theaters.
yeah.
That's too bad. Being in the doldrums of the sort of residue of the Hollywood writer strike and stuff, where it's just there's no cool stuff coming out anymore.
Well, that's its weapons, at least.
Yeah.
As far as you and I are concerned, as weapons heads. Okay, let's tell people what we're going to talk about in terms of investing today.
So we are going to talk about the re-escalation of the U.S.-China trade war. We're going to talk about earnings season kicking off with the big banks and then some concerns about the credit market. And we are going to talk about October showing why Bitcoin is not a good replacement for gold. And after that, we're going to have Tyler Laundon of Cabot Small Cap Confidential and Cabot Early Opportunities. And he's going to join us to talk about presumably small cap stocks and early opportunities. But before we get there, Chris, it is your week to defend your take, which is there is a bubble in AI bubble talk. You have 90 seconds. You may begin.
Yeah, so you and I, as everyone knows, you and I were the first to say that AI was in a bubble, a couple months ago. Everyone knows this, but now everyone's saying it, and to the point where you know bubbles don't tend to burst. It's almost like a watched pot. A watched bubble never bursts. But that's not the real reason. So comparing, well, I do believe I'm going to undermine my argument before this is the best defend the text where you undermine your argument before you make it. Um, yes, I think the bubble will burst on AI in the next 18 to 24 months. I don't think it's about to burst the way some people are talking now seem to think. I mean, capital expenditures are like between 300 and 400 billion dollars on AI with 60 billion dollars in revenue. That's roughly six times, capex to revenues, which is about twice what it was before the dot-com bubble burst. So again, I'm undermining my argument here. But here's the thing: there's no pets.com right now. Pets.com was 150 million dollars to generate $600,000 a month in revenue. That's just over $7 million in revenue. ChatGPT is has generated $10 billion in revenue over the last 12 months, and it's only growing. I think we're at a little bit earlier innings of this. The
Time. Yep. Well
data
over.
center build-outs, what they accounted for in GDP growth last quarter. It's a real thing. There's a real buildings being built. I don't think we have reached our pets.com moment yet. Oracle might have been the closest thing, but Oracle's not pets.com. That's, a giant company. Um, this is more of a timeline thing than anything. I don't think the bubble is about to burst. I think we're at least a year out from that, I think is my main point.
All right.
And everyone is talking about it. Wall Street fears it's the unknown that really that really causes stocks to implode, whether it's a certain sector or stocks as a whole. It's not the known, and everyone is talking about AI bubble bursting right now.
Yeah. My counter for that is in just pulling this off of the St. Louis Fed, the number of listed companies in the US per million people. 1996, it was 30 per million people. So there's around what, like 10,000 companies
Mhm.
publicly listed. Right now, it's at 13. Um, so there's about a third as many publicly listed companies. There, my bear counterpoint to it's not going to burst immediately because we don't have a pets.com is we don't have any small companies really. So it's like the stuff that was happening in public is now happening in private, is now happening in like the VC space.
Yeah.
There are probably tons of unprofitable AI like startups, and there would have been tons of. So the counterpoint to that, to my counterpoint to your counterpoint, is
I
that
counterpointed myself at the beginning of my own argument, so
yeah,
keep it going.
so my counterpoint to that would be there were also tons of private and venture capital backed .com companies, right? Like there's not really any kind of visibility into those numbers. Um, Also, there's a there doesn't seem to be a middle ground, right? Like the shrinking of the middle class of companies. If you're a big company, you can afford to train AI models and build data centers. If you're a small company, all you can do is sign on with one of the giant companies to use their models, right?
Yeah.
Like there's not a middle ground that can go direct to consumer or where you can do like a discount version or something. I don't know. I don't maybe like I
Yeah. Again, for me, it's a timeline thing.
yeah,
I think we even said, um, yeah, I think said that there'd be a cratering, in about a year to 18
yeah.
months. And that's still what I think. But people are talking with urgency now that AI bubble, and I just don't think that's usually the way it works. Is when you take your eye off the ball is when you swing and miss, generally. And I could see this quarter, the last few quarters, last 2 years of quarters earnings have been well above pre-quarter estimates. Like last quarter, for example, 12% was the actual number versus like 5% estimate, 5 or 6% estimate. This 8% estimate this quarter. I could see us being double digits, well into double digits because AI, helping drive all these, companies' earnings higher, and that being people dropping the whole AI bubble talk after this quarter, and then it could get start could get a little dicey once people stop mentioning it.
Yeah, and I mean the other tough thing is like it comes down to five guys. Like if Elon Musk, Larry
Not the
Ellison,
restaurant.
right,
Five
not
people.
the
Okay.
burger restaurant,
Okay.
comes down to five individuals that are making investing decisions. Like if
Right.
Mark Zuckerberg, Larry Ellison, Elon Musk, Satya Nadella, or I don't who's the CEO of Microsoft right now? I don't
Yeah. I
remember
can't
his.
think of it. Yeah.
Anyway, so like if those five guys decide, yeah, we're not going to throw hundreds of billions of dollars at capex anymore, that's the deciding factor.
Yeah.
Um, so that makes it, I think, uniquely tough to like. It's already a fool's errand to call a top, but it's extra tough when if they think that they're building towards like AGI or ASI, they could just spend that could be their life's work and they just plow their entire fortunes into it and it
Right.
never ends.
Yeah. Expenditure growth slowing and revenues catching up. AI revenues catching up, which again, it's a six times gap between expenditures and revenue right now. So it would take a lot of catching up. Okay, let's move on to our big three. Number one, US, China. Tensions re-escalating. Back in the news, we touched this was happening in real time when we recorded last week. S&P down, less than 2% since this started a little over a week ago. But the VIX has really spiked. The VIX had been in like the 15 range, this volatility index, for really weeks, months, and it's back up around 24, 25. Highest it's been since May. Number of 52-week lows on the New York Stock Exchange, the Nasdaq, are escalating. Anything beyond 40 is sort of Mike's rule. Is a bit of a yellow flag. We're above that, at least on the New York Stock Exchange. Um, but then, Trump, President Trump knows how much the market hates this trade war, right? And that's why he backtracked immediately after, making all these threats, I guess on Truth Social last Friday. Over the weekend, he kind of backtracked, and now he's saying, the high tariffs are not sustainable. High tariffs on China not sustainable. Um, where do you think this goes?
I mean, so
Both
Treasury
both
Sec,
countries tucking their tails. Actually, more likely to be us tucking our
yeah,
tails.
we need.
Maybe not.
I mean,
China doesn't seem to care.
the rare earths thing is, I think, the big thing, right? Like any advanced tech, we need rare earths. We need them for jet fighters, probably high performance drones. We need them for EVs. We don't have super viable sources of that, although like MP Materials and some of the US listed rare earth companies are sort of doing well.
Yeah.
But then one of the consistent things is that we see is political leadership seemingly trying to like will into existence things that actually take time. It's all well and good to say we're going to onshore all this manufacturing and to use that as a talking point, but then when the rubber meets the road and it takes 2 years to build a manufacturing facility or 4 years to build an AI data center, or it takes 18 months to get a mine from like the approval stage to where it's actually producing output. There is a significant disconnect between like the rhetoric and what the reality of a lot of this stuff is. I do think that we probably tuck tail a little bit, although the Treasury Secretary said they're not going to look at the stock market when they make these decisions. But I think that's just
I
trying to
don't
get
buy
ahead
that.
of a
Yeah.
very common criticism. Yeah.
Yeah, I don't
The
buy that
talk.
one bit. Their actions counteract that. Every time the market panics after tariff talk, they come back and almost immediately counteract what they just said, or at least to a degree. I think we need China. China maybe needs us less than we need them.
Yeah,
But
I don't.
I think to a degree need each other. And I think both countries will realize that. There'll be tariffs. There have been tariffs, high tariffs, but I don't think it's going to be nearly what's been threatened in recent days.
Well, the first time around, it was 130% tariffs on China, like back in April, and 100% this. And then it sort of settled at like 30%.
Yeah.
And maybe after this, it's like, okay, well, we're going to do an extra 20. So it's up to a 50% tariff. Um, S&P Global did a study that came out either yesterday or Wednesday that found that 1.2 trillion was their conservative estimate for added expenses due to tariffs, two-thirds of which are being passed on to consumers. So even setting aside the rhetoric of it, um, U.S. consumers are overpaying hundreds of billions of dollars. That seems likely to continue. Like the economic tail or headwind and fallout of this seems likely to continue, even if the rhetoric tones down and maybe
Right.
like 40% tariffs in China. I don't, I,
We'll see.
it, yeah.
Yeah. I mean, it seems like it's the rhetoric for much higher tariffs that scares Wall Street more than the reality, at least for now. So we'll see where things land. But I think it will be, it'll be more toned down than what has been. threatened, or what
Yeah,
was threatened a week ago.
I mean, even with the toned down rhetoric, you still just end up gumming up the works, right?
Yeah,
There's more fees, or it's harder to import stuff because now you have to individually calculate tariffs on every package, and stuff sits in ports. And now we're adding, both countries are adding something like $50 per ton port fees for shipping between the two companies. So it's like all this stuff just sort of grinds what is a sort of high performance engine down. It just
yeah.
gums up all the works. And it's going to be ugly and unpleasant. And, hopefully we can just sort of get through it. Although, got what, 3 more years and change of this, maybe? I don't know.
I don't know what you're talking about. Okay. On a brighter note, earnings season is underway, and the big banks, at least, um, you know, J.P. Morgan, Citigroup, Bank of America, Goldman Sachs, Morgan Stanley, all had very strong earnings. A lot of that was because of a strong quarter for the market. Investment activity way up. Um, all of them beat estimates pretty handily. Morgan Stanley beat by more than 30% EPS estimates, and most of the big bank stocks were up. Goldman Sachs fell. I think just maybe they didn't beat by enough. I don't know, but that has been counteracted a bit in the last couple of days as regional banks have taken it on the chin, mostly due to credit fears. There are two regional banks in particular, that had a rough quarter. Zions Bank Corp. They disclosed a $50 million charge tied to commercial loans from its California arm, while Western Alliance said that a borrower failed to deliver the promised collateral. It seems to tie in with two bankruptcies: First Brands and Subprime, which is a parts company, and subprime lender Tricolor, two companies I'd never heard of prior to this, filed for bankruptcy in September. So it's caused some worries about other credit defaults. I think Jamie Dimon, who we talked about extensively here last week, called them cockroaches. There's usually not just one. That's more symptomatic, and there may be more. I don't know. What's your read on, I guess, the dichotomy between big banks flourishing and regional banks, at least these two, so far having credit concerns.
Well, I will add that Jeffries was a big
Jeffries, yeah,
suffered largely from this. They fell like 11% yesterday.
yeah,
Um,
and they've
they
all bounced back some, at least to a degree today. But
Yeah.
the today's or yesterday's fall was much bigger.
Yeah, Jeffries, I think, has recouped about half their losses.
Yeah,
Like you said, Jamie Dimon saying, well, it's cockroaches. If you see one, you've got more than one.
yeah.
Um, I've seen other analysts coming out saying, well, one cockroach doesn't like a catastrophe make. So kind of a different perspective there. JP Morgan actually, the bank shares themselves fell like 4% after reporting. They upped their credit loss, or their credit costs, came in at 3.4 billion, their highest
Hmm.
since the first half of 2020. 2.6 billion of that was charge-offs, and then they had another 800 million that they allocated towards their loan reserves. Um, I don't know. The problem with what's the first parts? Is it first parts?
First, hold on. Yeah, I mean these are so obscure. First Brands.
Yeah, so the first brands issue was they were using invoices to go around to these regional banks and get loans off the same invoices. So that's not really like a systemic credit problem. That's an individual fraud, and it's maybe a criticism of the risk controls for these banks that were hurt. And if
Mhm.
you've got like bad risk controls in place, then that raises the odds that you might have other bad loans on your books. But it doesn't seem to be systemic failure that is arising because of anything in particular. Maybe it's an early warning sign that ongoing difficulty in the broader economy, especially for like small businesses, maybe this is just like the early crack showing,
Mhm.
and that it could point to more significant losses down the line. Uh, I don't know. I'll be curious to talk to Tyler about it because he
Yeah.
is more in the small cap space. But like you said, the big takeaway from the big banks is they're all doing really well because of market activity, M&A especially.
Yeah.
Mergers and acquisition volumes were up 33% year to date compared to last year. JP Morgan, their market revenue was up 25%. They, who else? I had Goldman Sachs, their investment banking revenue up 42%, their
Yeah.
IPO and mergers and acquisition revenue up 22%. But like JP Morgan's assets under management only grew by like 18%, which is, pretty much just market growth.
Yeah.
So these are companies that all do really well when the markets are seeing volatility and you've got more deals. Certainly the politics of the day are pro deal and pro merger. We talked about more IPOs and more mergers, a couple of weeks ago. So it all looks good, and then the question just becomes: is that are those defaults signs that there might be bigger risk further down the road? And I think it's too early to really call that. But
Yeah, I think the
certainly,
positives of the big banks, kicking earnings season off this way and all beating pretty strongly. Yeah, I think that's more of a net positive, you know, start to earnings season, specifically the bank earnings season, than a negative so far. So yeah, we'll see where it goes. Number three is gold versus Bitcoin. So, so I think some people have tried to try to make the case for Bitcoin as being like a stand-in for gold, as this, a hedge against the dollar, or, safe. I don't think anyone would ever associate Bitcoin with safety, but that narrative has been pushed. Well, this month has been an example, the latest example of that not being the case. Bitcoin is off 15% from its highs. This is in the last 12 days, down from 124,000 to 105,000. Gold, meanwhile, its utility has been demonstrated in the last week since all these China fears have come to the market, up more than 7% to new heights. Gold was already red hot. It just keeps going to record highs. It's above 4,000 an ounce, well over 4,000 an ounce now. Um, I don't really have much of a takeaway other than Bitcoin is, as we've said, purely a bull market play. Now, not that the bull market is over, Bitcoin could well bounce back, but when there's weakness and fear in the market, Bitcoin, crawls under its shell and retreats, whereas gold only strengthens.
yeah, and I think you see that reflected in analyst commentary too. This week alone, we've had a number of big banks and investment houses coming out saying, "Hey, year-end target of gold is 5,000." Just had a smaller analyst
Right.
come out and say gold to 6,000 by the end of the year. We are not hearing bullish calls on Bitcoin, right? People are not largely coming out and saying, yeah, Bitcoin's going to 150. I do think that most investors see it as a risk asset, and the projections and the announcements and all that stuff are reflective of that. Um, Also, you're not seeing, it's not like when we talk about central bank reserves that we're talking about like, oh, well, China's now they've got $40 billion in Bitcoin. It's no, they
Right.
have US dollars or they have gold.
Right.
Um,
Yeah, gold is the thing, this is the asset that's gaining in prominence as the dollar is weakened, not Bitcoin.
right, exactly. Um, yeah, I'm still bullish on gold. I gotta say, through the early parts of this week, I was very much thinking, or saying that I didn't think gold could hit 5,000 because it very quickly roared through like 4,300 an ounce, and I think it's
Yeah.
near that level today, even with a little bit of a sell-off in gold. Um, but yeah, it's a Bitcoin, I think, is a bull market play, and I think it got a little bit of a tailwind from the sort of de-dollarization, staying away from cash, looking for alternative assets, but it seems probably less sustainable than something like gold at 4,500, 5,000 an ounce. I think
Yeah.
Bitcoin will
And,
probably
I'll
pull its
add
head
that
back.
Bitcoin falling 15% in less than a couple weeks is another sort of yellow flag to add to, the possibility that a broader market pullback is coming. It being, a bull market play. So something to
There
keep.
is, just as a final note, there is probably a high correlation between investors that are buying Bitcoin and people that are like heavily invested in tech. So if the Bitcoin buyers are maybe feeling the tech growth slow down a little bit, Bitcoin becomes sort of a selling asset. If you're like an ETF investor and you're in the S&P 500, you're not necessarily going to pull back on gold because you feel like risk is coming off the market. So there, I wonder if there's maybe just a if there's just a sector correlation that's really, really high, um, coming from the investor type that is buying it as well. So even if it's not even if it's not perfectly correlated to the general assessment of risk in the market, maybe it is highly correlated to the risk in a particular sector.
Yeah.
So
Um, okay, let's in just a minute we're going to welcome on our guest for the day, Tyler Laundon. But first, I want to tell people about our offer for today. If you go to cabotwealth.com/street, we are offering Jacob Mintz's options trading service, Cabot Top 10, or excuse me, wrong offer. Mike Santolo's momentum trading service, Cabot Top 10 Trader, for $200 off the normal price, $497 for the year. You get 10 new stock picks every week, every Monday. Um, and they're not just pure growth stocks. Mike, with this service, is able to sort of go where the market winds are blowing, wherever there's momentum. So you get a 30-day, 100% money back guarantee if you want to just try it out. But again, you get weekly uh, issues with 10 new stocks every Friday. You get updates on a lot of on past picks, whether to book profits on some, to buy more shares of others, sell others, and just his takes on the market. And you get a free special report how to squeeze an extra 50% profit out of every trade. Also, how to play the AI megatrend. Again, go to cabotwealth.com/street and you get access to Mike Santillo's Cabot Top 10 Trader for $200 off the normal price, for just $497 for the year. Okay, take a quick break and we'll welcome on Tyler Laundon. All right, welcome on today's guest, Tyler Laundon, Chief Analyst of Cabot Small Cap Confidential, Cabot Early Opportunities. Tyler, welcome. Figured it was a good time to have you on. Small caps have been outperforming, at least to a degree, lately, and certainly have been on just as good or even better run than large caps since that April bottom. Now we're entering third quarter earnings season. I know you've talked about how small caps have underperformed large caps in terms of earnings growth in the last couple of years. That's been a biggest reason for their underperformance. But it seems like that is about to shift, partly because of the rate cutting environment that we're in. Talk about that shift that might be starting this quarter.
Yeah, so well, first of all, good to see you guys. Chris, Brad, nice to see you. Thanks for having me on it. Yeah, Chris, so I pulled some numbers and we wrote an article on the Cabot website. I think it was early this week or maybe last week, but basically flagging that the earnings growth rate for the S&P 600 small cap index supposed to accelerate. So just using estimates for this year, S&P 600 earnings is supposed to be up around 11%. And I think it's about 10% for S&P 500, right
Mhm.
around there. It's the small cap earnings growth rate gets the nod by about 1%. And then for next year, it's about 18.5% for small caps and what did I say? 12 and a half, something,
Yeah.
13 and a half for large caps. And obviously those numbers are going to move around as we get deeper into earnings. We're looking out a year plus. But big picture, what that shows is this expectation for rates to fall further should help um, lower the interest expense that a lot of small companies have because they have variable rate debt, a much larger percentage of that than large caps, which have more fixed rate debt. So bottom line is you get a really, really immediate boost to earnings through lower interest costs. So that's kind of like what we've been looking at. And there's other things going on. The economy has been pretty resilient. So obviously there's lots of noise out there. But when you step back, this earnings growth for small caps is one of the things that we really need to kick the asset class into gear again. So that's really what I'm watching pretty closely.
Are you just big pic? I mean, I know you're small cap focused. Are you, is this the year, right? Like that's the question, right? We've been waiting for small caps to outperform. I like small caps on a valuation basis. Um, but like what's the turn time for when rates start coming down before we really start to see that small cap outperformance kick into gear?
Yeah, well, it's usually in the at the beginning of a rate cutting cycle. Like historically, if you go by,
Interesting.
you're just going to pull historical averages for how small caps do when rate cutting cycles begin. They start to outperform right at the beginning. A lot of that has to do with the outperformance of small cap value stocks. But, like as a practical matter, if you're, for how you're going to enact a strategy, right? Like, are you going to go buy a small cap ETF? Are you going to go buy a small cap value ETF to try to play that? I think it's best not to try to get too granular. From my perspective, I think it's a good time to be owning a broad-based small cap ETF for anybody, right? I just think it's a good time to have exposure to that asset class because whether or not it outperforms the S&P 500 or not this year, it should be right in the mix, right? And whether or not this is the year after so many years of underperforming, like you said,
Of Lucy pulling the football away
yeah, I mean,
from Charlie Brown.
who knows, right?
Yeah,
Like
yeah.
we all have looked foolish for making calls that haven't played out. But I think I think there's enough evidence to suggest that it's a good time to have a decent amount of exposure. And obviously, how much that is relative to, an individual's circumstances. But it's interesting because we talk about this and we write about it at like at a high perspective level for small caps in general. But of course, what we do day to day here at Cabot and through the Cabot small cap advisories, we recommend individual stocks, which often move completely independent of what the index is doing, right?
And is there a small cap index ETF you like better than others?
Well, over the long term, I like the S&P 600. It's a higher quality index for sure. Although the Russell 2000, and you can get exposure to that through the IWM ETF, that has
Yeah.
outperformed since the April lows because there is a much higher share of lower quote unquote quality stocks in there that don't, these companies don't have positive earnings. But that's been where a lot of the action has been lately. There's been more speculation in lower profit or non-profitable companies, and that's really helped the Russell 2000 outperform. But you look at a day like today, we were just talking about this before we jumped on, but the Russell 2000 has a little more exposure to lower quality banks, and that's hurting it today versus the S&P 600.
Yeah, let's get into the banks. Brad and I touched on that in our opening. Yeah, some regional banks, namely, Zions, Bancorp, Western Alliance, Jefferies have um, taken on some water, especially yesterday. They bounced back some today due to some credit fears. You know, uh, Possibly partly due to bankruptcies among two parts related companies that I've never heard of. But what is your what's your take on, because there's a lot of small caps that are or a lot of regional banks that are small caps. What's your take on how this could impact, regional banks and small caps as a group, or is this are you waiting to hear more to, make that determination, I guess?
Yeah, I mean, I wish that I had access to, the information that the big banks have, but but I don't. I think that it's really unfortunate because we had sort of been expecting that, financials really should be doing well right
Mhm.
now, right? Like interest rates falling. We heard from the big banks that the investment banking arms are doing really well.
Yeah.
they should be looking at a lot of these small cap and regional banks as acquisition targets, you would think.
Right.
So to have this kind of news come out right at the beginning of earnings season when we were expecting that things would sound pretty good from the banks, I think it's kind of unfortunate. Wasn't really expected, of course. I mean, we're all surprised by this. I think that um, we're going to have to be a little bit patient, but I would expect that the potential acquirers are putting a lot more work now into trying to figure out what their acquisition targets, if they can get those acquisitions done at a lower multiple than say a
Yeah.
week ago.
Yeah.
So I think that, eventually it's going to be looked at like as an opportunity, whether that's right now or next week or 3 months from now, who knows?
Yeah, and those potential acquirers are in a even more of a position of strength because the big banks did quite well this week. Almost all of them beat earnings handily, and their stocks were up, resulting. And a lot of that was because of investment banking and M&A activity during the quarter. So,
Yeah.
yeah, it could. I guess you could make the case that falling valuations for regional banks combined with escalating valuations and just revenue for the big banks could be a recipe for more M&A.
Yeah, I mean, we're going to get into, we're going to move on from the financials next week as far as reporting season goes, right? So, assuming, I mean, this is a big assumption, but assuming that we don't start to hear all kinds of tragic stories of bankruptcies and
Yeah,
bad loans, then attention should shift to other areas of earnings, which I think could get the market going again, right? We're going to have Microsoft, we're going to have all the big mega caps
right.
reporting earnings soon. So we're all gonna be super interested in what happens there. And if no more bad noise comes out with the regional banks, I think that's gonna become old news pretty quickly, I guess is
Yeah,
what I'm saying.
yeah.
Are there any sectors where you're looking for like meaningful earnings growth, whether small cap or otherwise, aside from like tech, anything that's on your radar to really pay extra attention to?
Well, I think like at the index level, we look at financials. I mean, kind of the story of the week, right? But we should have been seeing better earnings out of the financials, and that would have helped, or that should help the small cap index because it is a pretty high allocation. I think I think the rate sensitive areas, materials,
Yeah.
um, the utilities is kind of an interesting story because of what's going on with AI and power demand and all that. So that's you don't really think about utilities as being a super high growth area, but I I think it's just the whole mix, Brad. I think that when I'm kind of breaking down the areas that we are overweight in the small cap portfolio, it's still going to be med tech. It's still going to be software. There's going to be a little bit more of the AI infrastructure names right now. So that's really, most of my energy is going into figuring out what I think the earnings profile is going to be of the companies that we own. Um, we have that earnings season ramping up the week after next for our portfolio.
Is there something that could happen either during earnings season or just in, you know, uh, the index? I mean, I guess we're going by the Russell 2000. I know that's as you said, it's been better performing than the S&P 600. But that has just recently topped its 2021. It had been below its 2021 peak, unlike the large cap indexes until the last few weeks. And it's right around that peak right now. I mean, is that index racing above, those 2021 highs? Would that be sort of a technical indicator that would, give you more of a green light with small caps, or are you just, or earnings the bigger tell, I guess?
I think it's both. I mean, I think we can't, we all know how important investor sentiment is,
Yep.
right? And like the last week, 2 weeks, I think the dip buying has been driven mostly by retail investors. So we have to recognize how important that is and how much people will look at a breakout above, previous all-time highs as being hopefully, I think, a bullish signal. So I think that that is quite important. I mean, if we look at the chart of the IWM, I think what it was on Wednesday, it was above its all-time high, and then
Yeah.
yesterday kind of fell back to it, and now we're a little bit below it today. So yeah, holding up around this level, I think is quite important. I mean, if we fall back down to, 5 or 10% below, that's not to say that we can't come back from there, but um, it would be a more bullish signal for sure if we could hold right around this level, get through the week, and then hopefully, recuperate some next week.
I wonder, I was thinking about this, and maybe you can sort of complete the question for me. Um, obviously for the last couple of years, AI has been like the big narrative. Has that served maybe as a little bit of like a money vacuum? Is the push to like AI names, which is all large cap, I mean, honestly, like all mega cap, is that hurting maybe some of the investment in small cap that we would have expected to see in like another cycle? Like in a normal sort of bull market coming off the lows of like October 22. Um, I guess I'm looking for maybe kind of a big picture explanation for some of the underperformance, or is it just because interest rates are so high?
I think that if we really want to break it down, I mean, I think the high interest rate story is a significant issue, and the variable debt that smaller companies have, like again, at the index level. I think to your point about AI and whether or not that's drawing all the money, creating a vacuum, I actually think that excitement is helping small caps. I mean, I'm looking at charts all day long of stocks, small cap, mid cap, micro cap stocks that are, they're moonshots in the last 3, 6 months. A lot of these are up 100%, 200%. So I think that it's drummed up a lot of excitement for new, fresh stories, and a lot of these smaller companies are definitely doing well. I mean, it's showing up in the numbers. So I don't think it's created a vacuum. I think that, and not to get super boring about the small cap index makeup, but there's a whole story of like we have a lot, the S&P 600 and the Russell have a lot of companies in there that are, carrying significant weight that are 5, 6, 7, 8 billion market cap companies. So it takes a lot of sub 500 million market cap companies to equal the weight of an overweight position in an 8 billion market cap company. Um, so the point is there's a lot of index dynamics going on, but I think big picture, I think there's a lot of excitement out there for individual stocks and a lot of small cap stocks. So I don't think it's created a vacuum at all. I think it's only helped.
Yeah, and during periods where the small caps outperform large caps, which I think you've mentioned on here before, happens historically 3 out of every 5 years. It's been longer than that, so they definitely do. But when they do outperform, I know that your portfolio and Cabot Small Cap Confidential absolutely flourishes. I think I remember last time that small caps were outperforming large caps. I think you had a average gain in there north of 200%. So if we are going to get a small cap period of small cap outperformance, which the conditions are really shaping up for that, I highly recommend subscribing to Tyler's Small Cap Confidential newsletter, which is on the cabotwealth.com website under premium advisories. Tyler, thank you for joining us and imparting your small cap wisdom. And thanks everyone for joining Street Check, and we will see you again next week.